Hello, everyone. So, we are going to start our weekly recap. A couple of things. So, I tried to stream from a third party platform last week. And while it did go well here on YouTube, it did not work on Instagram. So, we are not doing that today. I am just streaming here on YouTube. I will still have to work on finding a platform that I can use to stream in both places at the same time. Second thing, I realized that my 4K camera really made me look whitewashed, if that makes sense. So I am not using my 4K camera today. I'm using the camera on my MacBook Pro. So hopefully the quality of the video looks a lot better. But I did realize that I can share my screen within the YouTube platform, so we can still look at data and metrics together as we start talking about company earnings and financials and all of that. So hopefully it will work during this live. I did test it earlier today, and it did work. Knock on wood. Hopefully it will still work now that I am live publicly. So, in this week's recap, big news came out at the end of this week. So, it looks like Dick's Sporting Goods is going to acquire Foot Locker. Now, I am kind of surprised. I see these two as competitors, never really saw one wanting to acquire the other. But what I will say is the retail space has been struggling for quite some time. Some companies are doing better than others. So, with that being said, now is the opportune time for companies that are doing well to kind of swoop in and acquire and take over some of the companies that aren't doing so well. So, just for context, Dick's Sporting Goods is about double the size of Foot Locker in regards to revenue. So, let's say, for example, if Foot Locker is about $7 million or $7 billion per year, Dick's Sporting Goods is about 14 billion. So there's that. Now, this acquisition definitely makes sense for Dick's Sporting Goods for a couple of reasons. So, one, this will give them a huge advantage when it comes to bargaining and having contracts with Nike, as this will now make them one of the largest purchasers and retailers of the brand. This will also give Foot Locker, not Foot Locker, this will give Dick's Sporting Goods a global presence. So currently, Dick's Sporting Goods only operates here in the US. Now, with Foot Locker, of course, they have locations all across the globe. So this will now help Dick's Sporting Goods expand their global footprint. Now, presently, they don't have any plans in merging the brands per se. They still plan to operate each standalone business as it is present day. Now, of course, that may change over time, but currently that is not on their timeline. So there's that. So I do want to share my screen so we can look at some of their financials. I think it will be pretty telling. So let's see if I can get this to work. Okay. So I've got Foot Locker here. And hopefully, okay, it is working. Fantastic. Now I just need to get back to the window that's being shared. Okay, so let's first start with Dick's Sporting Goods. Why won't it? Let's see what's going on here. I'm not sure what's going on here. There we go. I'm not sure why it didn't work before. So, when it comes to doing research, I love using Yahoo Finance. And no, this is not sponsored. I do find that Yahoo Finance really offers a great way to do high level research in regards to stock price, financials, and just learning about the overall company. And if there are any current events or articles, they will put that kind of below. So, just to kind of walk you through this quickly. So here's a nice snapshot of the stock performance of Dick's Sporting Goods. So you have your 52-week range. If you're not familiar with what that is, this is just showing you what the lowest stock, how low the stock has been in the last 52 weeks or year. And then this is showing you the highest price the stock has been in the last 52 weeks or year. So this really helps you understand how cheap or expensive the current stock price is in regards to how it has performed in the last year. So this is definitely a great metric to pay attention to. You also will see right their earnings date, which is basically when they're going to have their earnings calls. You could also see the ex dividend date. Now, what that means, in case you don't know, you must own the stock the day before the ex dividend date in order to qualify to receive your dividend payment. So if you own the stock before March 27th or before March 28th of 2025, when the dividends are paid out, you will then receive it. If you own it after this date, you won't qualify, but you will receive it the next time around if they do in fact pay dividends. So I don't want to go into a stock lesson. I will say that for a future live, but just to kind of give you some examples of how useful Yahoo Finance can be. You are also able to use the platform to look at the company's financials. Now it looks different now that I'm sharing my screen. So I have to figure out where, oh, it's on the top bar this time. Okay. We look at the financials. And if we look at total revenue, on an annual basis, we'll stay here. You can see they've had steady revenue growth in the last 3 years. So they were at 12.3 billion as of 2022, 12.4 billion, right? So on and so forth. It's been slow incremental growth, but still growth nonetheless. But of course, revenue is one thing, income and profitability is another, right? So if we scroll down and look at net income, you can see here also they've had, well, here they had a significant decrease, but since 2023, they've had a steady bounce back from in their profitability, which is great to see. Now, this of course looks very different. Well, actually, before I do that, let's go back and look at the stock price. So currently the stock is at $184 per share. If you look at it over the last year, it has been very volatile. It's been all over the place. Now, of course, with the announcement of the acquisition, the stock price did take a bit of a jump, but now it's kind of back down. And so this is not surprising considering, again, retail has had a tough time in the last 2 years or so. But Dick's Sporting Goods seems to be doing relatively well considering. But if we look at Foot Locker, it's a totally different picture. So if we look at their financials, for example, if you look at total revenue, it's been slowly decreasing. You have about 9 billion, 8.8 billion. Slowly but surely, it's been chipped away at, right? And then if we look at net profit, oh, that's not net profit. This is net profit. They've had a significant decrease. They were quite profitable in 2022 and 2023 a decrease. Then they were unprofitable. I think it's 2024, right? In 2024, unprofitable. They've been able to looking at the wrong line again. Here we go. But they've been able to bounce back quite a bit in as of 2025, but they are apparently still struggling quite a bit. And then if we look at their stock price overall, you'll see in the last year, it's just been tanking slowly but surely. Now, of course, it did have a bit of a pop, again, due to the announcement of the acquisition. So this will be good news for both Foot Locker investors and Dick's Sporting Goods investors. Now, when it comes to the actual stocks, if you do own any shares of Foot Locker, they are actually giving you two options, which is really rare. Usually, you only have one option. You have the option to receive cash payment for your shares, or you receive shares of the company who is making the acquisition. So, for example, like the Capital One Discover acquisition, you are going to receive shares of Capital One in lieu of your shares of Discover. But no one had an option, right? But with this deal, you will have an option. You can receive a $24 cash payout for every share that you own, or you will receive a fractional share of Dick's Sporting Goods stock. I think it's like 0.11 shares or something like that. So a very small fraction, but a fraction nonetheless. And it is going to be of a company that's doing a lot better than Foot Locker. So this might actually bode well for Foot Locker investors. So definitely something we will keep an eye out. The acquisition isn't final by any means. They are in the stages of getting it completed. I don't think I mentioned they're going to be paying $2.4 billion to buy Foot Locker. That is the current price tag. And I, of course, will keep you posted as more information becomes available. Let me just flip over to see if anyone's here in the chat. There isn't, so I can keep this party going. So next on this week's weekly recap, Microsoft. So Microsoft announced layoffs earlier this week. And so they did lay off 3% of their workforce, which equates to approximately 6,000 people. Now, if you are on social media like I am, it's been all over TikTok. The employees that were impacted, many of them are just sharing their stories, mentioning how they were blindsided. Some of them, this is their first time being laid off. I did see one gentleman who had been with the company for 22 years, and now he's being let go, or he was let go. And so I think for him, it was definitely a very emotional experience, considering he's been with the company for so long. But when it comes to business, it is just business. It is not personal. I think that for a lot of people, they have a hard time coming to terms with that, because we are so tied to our job. We spend so much time with our jobs, and you feel as if you are important. And while you may be, we are all always disposable. When it comes to layoffs, you are literally a name and a number on a spreadsheet. And I'm speaking from experience in that I've worked in corporate finance for over 18 years, and I have had to work on layoff projects, meaning we need to save, let's say, $50 million. How do we do that? And so, of course, the first way is going to be headcount. People are most companies' most expensive expense. And so that is the first place they go to when they want to save money. And so it's never personal. It really is just business. It's about crunching numbers and how do we get to this number so we can have the cost savings. That's literally all it ever is. Very rarely is it personal. Now, of course, there will be scenarios where it might be personal. They picked one person over another for personal reasons. But for the most part, it's never that. It's literally just, how can I get to this number of cost savings? And these are the people I need to let go to get there. And then the unfortunate part is those who are left have to still complete the work now with less people available. So it ends up being stressful on both sides of the layoff. Those people who are left behind to take up the extra work, and then those who are let go, who now have to go out and find a job in this economy. Listen, it's tough. It's tough. It's tough. It's tough. And that is one of the things I really did dislike about my corporate job, and that I had to do that many times, working on these layoffs and calculating numbers, seeing names on a spreadsheet, and just knowing that, hey, in 3 months, you're not going to have a job. Because when layoffs are done, it doesn't happen in a week or two. This has been in progress for at least 3 to 6 months at a minimum. When you have a global company like Microsoft, there are so many layers to layoffs, from a legal perspective, tax perspective, financial perspective. A lot of parts have to be looked at before they can actually implement them. But that's not why we're here. So anyway, back to Microsoft. So in their announcement, they mentioned that the layoffs were not performance-based. It's basically trying to get rid of layers within the organization. They're trying to streamline more processes, yada, 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 right? But I think what's always so interesting is that people will get laid off, and they know the company is doing well financially, right? So sometimes you tend to equate layoffs when a company is doing poor financially, but that's not always the case. Sometimes, especially now, they're preparing for what may be ahead. And the biggest X factor right now is the tariff conversation, right? Tariffs, while we do have a temporary deal with China right now, we have no idea how that's going to play out or what the final deal is going to look like. And so, between that, the anticipated inflation, companies are buckling down. That's really what it comes down to. Even the ones that are profitable and doing well, they're already scaling back to, again, brace themselves for what is ahead. So we all should be kind of following that example as well. So when you look at Microsoft and you see their stock over the last year, also been very volatile. But sure enough, they've seen some pretty significant increases in the last, let's say, 3 weeks or so. And of course, they had a little bit of a jump when they announced their layoffs, because that tends to be how Wall Street responds to company layoffs. Funny enough, company is announcing layoffs and it's not due to poor performance, the Wall Street tends to like that, and the stock market responds accordingly. So if we look at Microsoft's financials, they've had, what's going on here? Give me a second, guys. I don't know what's going on with my screen right now. It's like doing this weird thing. Okay, I think we're good. Are we good? Not really. It's like doing this weird. I don't know why it's doing this. Let me refresh. Maybe that'll help. That is like the weirdest thing. Okay, here we go. So we look at their revenue, and it has steadily increased since 2021. So now they are, doing quite well. Now, if we look at net income, that also has increased since 2021. So if you are an employee of Microsoft and you're looking at this, right, you're on those town hall meetings, you're listening to an earnings call, you get those, company-wide emails that the company's doing well, then you're like, well, then why are they laying me off? I think I kind of already addressed that, but again, that is just par for the course, which is why we all should never be comfortable with whatever job we have, because no jobs are guaranteed, not even government jobs, as we have seen in the last, 4 to 5 months. So there is that. The stock price, if we look at that, let's take a quick peek at its dividends and all of that. So stock price, if we look at the 52-week range and compare it to now, the stock is on the more expensive side, but that's to be expected since they have had quite a bit of positive news lately. And so the stock is, again, more expensive. Now, what's frustrating about Microsoft, as expensive as the stock is, they don't pay a high dividend at all, which, they could technically afford to. They just choose not to. That's just my opinion. Anywho, moving on, I'm going to stop sharing because we're going to just pause talking about that right now. So the next hot topic this week is, of course, student loans. We are back to that conversation again. So as you may recall, May 5th was the deadline for student loan borrowers to essentially get their loans back into compliance. And so what that means is they needed to either start repaying their loans, or they needed to sign up for an income-driven repayment plan. And either one of those will put their loans back in compliance. Now, for those students, or not students, but for those who took out student loans, if they did not do any of those things, they are in jeopardy of having debt collection efforts happening this summer. So what that means is the government is going to hire agencies to come for their money, essentially, right? So they're going to start garnishing wages. If you are expecting a federal tax return, they're going to intercept that. They may even intercept state returns, but that is kind of a gray area. I'm not really 100% sure on how they're going to treat that. if you do receive any kind of government benefits, they will also attempt to garnish that. So they're coming full force for their money. Now, what I will say, what came out this week though, is they are really behind on applications. I see, hey, Michael, PFE on April 29th made profit of 92 cents with 26 cents more profit and beat what CEO said tariffs didn't hurt earnings. That raised the outlook, which I think has 300 drugs that raised the outlook. So PFE is Pfizer. Profit of 92. Okay. Tariffs didn't hurt earnings. Well, I think for Pfizer, I think it's a little too early to know whether or not tariffs will impact them. I think it's one of those TBD for them right now, but they definitely had a good earnings call. And I know my husband, for example, loves to invest in Pfizer. So definitely a company that is pretty solid in my opinion. So thank you, Michael, for the feedback. So back to the student loans. Now, the Department of Education states they are way behind on processing those income-driven repayment plans. And so to give you context, out of the 2.1 million applications, they've only processed 80,000. And that is a huge problem, right? For a few reasons. So one, if you signed up to be on this payment plan and you're waiting for it to be processed, you're kind of in limbo. So according to the government, you may be not in compliance. They may want to garnish your wages, but you've done your part, but you're waiting for the Department of Education to do their part. So this is definitely going to be a tricky situation for many people. And so I think this will change the narrative, the direction of how they're going to approach this. So hopefully they will put a pause on the collection efforts until all applications can be processed. So no word from the government on that just yet. But if they're behind on applications, you can't then start garnishing wages. You need to give people that fair chance to lower their payments, start making those payments, and then they can put their loans back in compliance. So there are like 9 million people who are impacted by this. That is a lot of people. So we will see how that plays out. I'll, of course, keep you guys posted. So in regards to earnings calls, let's jump into that. I'm going to go back and share my screen, and we'll talk about some companies that had their earnings calls earlier. So let me make sure you guys can see my screen. Let's see. Okay, yes, my screen is being shared. So Honda had their earnings call earlier this week. Revenue is up 6% year over year, but profit is down 25%. And they are forecasting a 59% decrease in profits in the next year. Now, of course, the main factor behind that is the tariffs. And so because we have this temporary deal, we don't know what the final deal is going to look like. They are forecasting doom and gloom, essentially, which, makes sense since they are, since they are a foreign entity and they do import many of their parts and their cars and things like that. Now, of course, when it came to their stock price, it's currently trading at $29 per share, and it's up. Well, it's up year to date. It's down 14% year over year. And so I think as they navigate through this landscape, this may actually decrease until they either one, figure out ways to counteract the impact of tariffs, or two, a better trade deal is negotiated and then they can improve their profitability overall. So only time will tell again how this plays out. But it was a not so positive earnings call earlier today. Let me just pack back over to see if there are any more comments. I don't see any just yet, so I'll just keep it moving. Next on the list is Walmart. So Walmart had their earnings call earlier this week, excuse me, and they did go over their Q1 earnings. Now, revenue is up 2.5%. Net income is up minimally. And so it was kind of like a lukewarm earnings call, in my opinion. They did talk about what is driving the revenue growth. Memberships are up in regards to Walmart Plus and Sam's Club, etc. But they too are anticipating anticipating the tariffs negatively impacting their business as well. So I think Walmart is such a huge player in the retail space. I think all eyes are on Walmart and how they're going to navigate the tariffs and how they're going to, and just to see what their results are going to be, right? Because Walmart is a huge player, not only here in the US, but across the globe. And so I think a lot of companies are watching them and may just mimic whatever they end up doing. But they've already anticipated having to increase prices due to the tariffs that were in place in the last 60 days. And again, we don't know what this final deal is going to look like, but it will most likely impact prices as well, not only for the tariffs, but I did a video, I want to say 2 days ago, where I talked about how inflation will still be an issue whether the tariffs end up being a good deal or not. And here's why I'm saying that. So for the next 90 days, the US and China have agreed to put a temporary pause on the increased tariffs, right? So they decreased their tariffs to 10%. The US is still adding 20% on China goods due to the fentanyl penalty they're imposing on China. And so we kind of have this space where things will be technically not as expensive as they were during this weird tariff phase. But with that being said, people are going to end up panic buying, whether it's small businesses, large businesses, or just us as consumers, because we don't know what's going to come down the pipeline. And so we kind of have this quiet phase right now where we know what the tariffs are. The prices aren't too crazy just yet. So you might be running out to just buy whatever you can because the prices are reasonable and you're fearful that the prices will be a lot higher 90 days from now. And so this is basic economics, supply and demand. So the demand increases, the prices of goods and services will also increase. So I think we're going to see inflation be an issue regardless of how things play the tariffs. So I think we have a bumpy and rocky road ahead. But of course, this is just my assumptions based on my experience and education. So there's that. Um, let's see. I think that was it that I had for today. I don't see any questions in the chat, but what I will say though is regardless of where you are when it comes to investing, now's the time to really pay attention to what is going on around you. I know for many people, they're just kind of throwing money into the market and they're not really doing much with it as far as research. They're just putting money into these investments. They're kind of hoping for the best. And like, okay, I'm doing something, which is better than nothing. And I get that. But we kind of have to move from a place of being passive to being more proactive. And so this means really listening to what's going on in the news around you, really pay attention to what you have in your portfolio. I can't tell you how many times I've spoken to people and they don't know what they have in their portfolio. They don't know why they picked the investments that they picked, and they're just kind of winging it. But we are at a time where you have access to so much information for free 99. You have YouTube, you have podcasts, you have TikTok, you have so many places where you can get information. But you have to make the effort. Like no one's coming to give it to you. And more importantly, no one's coming to save you. No one's coming to save me. So you really have to be more proactive. And it all starts with education and meeting yourself where you are, but you definitely have to start somewhere. Michael Anthony says, which is the best sector do you like the best where tariffs won't hurt? Ooh, that is a very interesting question. So let's think about that one. So of course we know retail will be impacted. I think travel might not be heavily impacted by tariffs. I think particularly US based companies, but then to the flip side, there are less international travelers coming to the US because of what's going on with the current administration. So that's one of those slippery slopes that could also negatively impact, but it's not tariff related, right? It's related to something else. So I kind of stick with my initial comment. I would say travel. What other sectors do I think? Healthcare potentially. Well, even that's kind of tricky because we do import medications. Hmm. Hmm. Maybe healthcare. I think I will kind of stick with that. But the healthcare sector, depending upon what you're looking at, is not doing so hot, right? We have places like CVS, Rite Aid, Walgreens, they're not doing too hot, but it's not because of tariffs, right? That's just for their own other reasons. Um, what else? What else? What else? What else? Hmm. I would say REITs, so real estate investment trust. I think that might be a good place that wouldn't be impacted by tariffs, right? So these are entities that own either real estate or they are leasing real estate, and there are right, and that's a way to invest in real estate without directly buying property. So REITs might be a great place that might not be impacted by tariffs. Um, this is a really good question, Michael. I have to think about that. So, travel, REITs, healthcare, maybe. Every other sector is tied to tariffs in some shape or fashion, I feel. Right? So, you think about electronics, we know that's impacted by tariffs. Think of retail, that's impacted by tariffs. Um, the energy space might be another one that could be not that heavily impacted by tariffs. There's so many gray areas though, right? There are so many gray areas, but I think that's a great question actually. So thank you for the question. It's definitely making me like really think because I haven't thought about it in that perspective. I kind of just have my investment strategy and I do things um where I'm looking at what's down. And if I believe in it, I kind of just buy more of it. So that's kind of like how I invest right now. So the tariffs, I'm kind of ignoring that I'm ignoring that to a certain extent, I should say. So Michael says, Rad filed for bankruptcy and think they are out of business. Let's see. Hold on a second. Let's take a peek. Who is? I don't think I know that ticker symbol. Rad. It's not popping up for me. Can you type out the company name you're talking about? I'm not sure. Um, Unless you mean Rite Aid. 'Cause I know Rite Aid definitely filed for bankruptcy. I know I saw earlier today that they are selling off many things that they own, and like CVS is like swooping in to buy some of their assets. So if okay, yes, okay, Rite Aid. Okay, thank you for that. Thank you for the clarification. So yes, Rite Aid definitely filed for bankruptcy. I think 2024, except Q3 or Q4 of last year, they filed for bankruptcy. And as I was just saying, CVS is swooping in to buy some of their assets at heavily discounted prices. So again, it's just part of what's going on in the industry. I did do a video. It might have been a short where I talked about that. Now, CVS seems to be really doing well. Now, the reason why they're doing better than their competitors is they've kind of diversified their revenue streams, right? So CVS doesn't only focus on medication, they've kind of transitioned to health services. So, for example, they acquired Aetna. I want to say like 5 years ago. It could be longer than that, but don't quote me. But they definitely acquired Aetna. They also have their minute clinics and they have their what is it? Their specialty pharmacies, right? They have that, and those beds are obviously more expensive. So they have found ways to really improve their revenue stream. So they're not totally reliant on reimbursement from the insurance companies. And truthfully, that's where they're losing money, right? They're losing money to or losing business to the big box retailers like Walmart and Target. Amazon, right? Amazon jumped into the medication space and they are just crushing these traditional pharmacies. So they have to get creative. And truthfully, that's going to be truthfully the path for all companies right now. If you can't find a way to become creative and strategic and competitive, you're going to be run out of business. There's just no way around it. And so this is why you see these strategic partnerships, you're seeing these acquisitions, because for many companies, they can no longer survive as a standalone business. They just can't. So they're either going to be acquired by private equity, or they have to acquire other companies to help improve their profitability and revenue streams, or they will be acquired by bigger companies that are doing better. And so what we're seeing right now with like Capital One and Discover, Foot Locker and Dick's Sporting Goods, right? We're going to see more and more of that. I think I also heard recently that JetBlue and United now are having a partnership. I don't have all of the details behind that. But again, these partnerships are how companies are going to survive. They can't do it alone anymore because we have this horrible economy, we have inflation, there's so many pieces, so they have to get creative. If they don't get creative, they're going to lose money and go out of business. So FL getting bought for, yes, correct. So I did talk about that earlier. So actually with that acquisition, you have two options. If you do own shares of Foot Locker, option one is to take the cash payout, as you mentioned, Michael, where you will receive $24 for every share that you own. Or your other option is to receive a fractional share of Dick's Sporting Goods. So investors actually have two options, which is pretty rare. Most times it's going to be one option and there aren't multiple. So I thought it was kind of interesting that this deal is being proposed as such. But of course, it's not final yet. That is just what's on the table. They will also have to finish final T's and C's, get approvals and things like that. So I'm not sure what the timeline is on the deal being finalized, but we will know, I'm sure, in the upcoming months. I believe Dick's Sporting Goods has an earnings call later on this month. We could look it up right here, actually. Is my computer frozen? Nope. But oh, that's why. Ha, so silly. I believe Dick's has an earnings call. It's not popping up here. Normally, when I look it up on Yahoo Finance, it will show it to me, but it's not. Oh, key events. It's not. Let's look it up real quick. Dick's Sporting's Good. Earnings call. Yeah, so their Q1 result is scheduled for May 28th. So I'm sure they will give us more color, as they love to say, about the deal and the timeline and all of that. So I will, of course, keep you guys posted as that comes up. So we will see, what they say and how that's going to play out. Now, of course, as we get closer and closer to whatever timeline they put out, most likely the stock price will continue to increase until the deal is final. So that is just how that usually tends to play out. So yeah. All right. So that is it for today's live. Thank you everyone for joining. Thank you, Michael, Anthony, for your comments and your feedback. I really appreciate you. If you're not following or subscribed to my channel, feel free to subscribe. I do go live at least 3 days a week and talk about investing, mindset, and things like that. I do these weekly recaps on Friday evenings. And then if you have any topics you want me to cover in a future live, of course, just put a comment in this video or future videos, and I can definitely do that in a future live. I also do credit card reviews and financial product reviews as a way to kind of help people understand the different options, perks and benefits, the pros and cons, and all of that. So we discuss everything related to financial literacy over here. And of course, I'm on all social media platforms, Instagram, TikTok, Facebook, here on YouTube, Threads. So wherever you're hanging out, I'm hanging out there as well. Michael says, I was looking at each HELE could be at a discount when shares were over 100 and now 30. Okay, let's take a peek at that before I wrap up. Let's see. Let's take a peek-see. I'm not even sure. Helen of Troy. This is new to me. I'm not familiar with this company at all. So let's see what they're all about. So let me know, Michael, what you really like about this company. Just really curious. Oh, wow, it's down 72%. Ouch, ouch, ouch. Okay. So with Yahoo, what's great is you can just get a quick You can do some quick research on a company. So I like to go to the profile, and it'll tell you that they're in, where they're based out of. It'll give you their website. I skip this part. I don't care about the executive board and all of that, but I go to here the description. So Helen of Troy Limited provides various consumer products in the U.S., Canada, Europe, and the Middle East, Africa, Asia Pacific, and Latin America. Operate in two segments: home and outdoor, and beauty and wellness. Huh. Oh, let's see. Okay, so they sell its products through mass merchandisers, sporting goods, retail, department stores, drugstores, okay, yada, 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 and various types of distributors, as well as directly to consumers under the OXO. I know OXO. I use that like in my kitchen. I have a lot of kitchen products from them. Hydro Flask, I know that brand. Osprey, I know that. Dry Bar, okay. Hot, oh, okay. I use many of these products and didn't even know. That is so interesting. Wow. Okay. They were incorporated in 1968 and they're headquartered in El Paso, Texas. Okay, I'm learning something new today. This is why I love having community. We get to learn from each other. Okay, so this is the profile section of Yahoo Finance. So we got to get a quick summary of what the company is about. And then we can kind of go back to the summary and look at the stock price. Let me see if Michael says anything here. He says they have coolers and many of their items are at most stores. Yeah, so I see that now. So that's great. They sell many household brands, essentially. Many of those brands I either know of or I have used personally. So the stock is down almost 72% in the last year. So if you know why, Michael, feel free to put that in the chat because that is very interesting. But I guess I would say it kind of goes back to what we mentioned earlier. The retail space is struggling right now. And if companies are just operating at status quo, they're not going to make it. They are not, especially with tariffs making the cost of doing business more expensive. If you don't find ways to increase your top line and also reduce expenses, it's hard to maintain profitable. And over time, if you're not profitable, you will go out of business. You will go out of business. So the stock is, what is it? $30 per share. Wow. So I always look at the 52-week range to kind of understand how cheap or expensive a stock is. And so this stock was the lowest price in the last year was $24.15, and the highest was about $110. And so, of course, at $30 per share, it's on the cheaper side right now. They don't pay dividends, as you can see here. There's no forward dividend yield. There's no forward dividend or dividend yield, excuse me, and there's no ex-dividend date. So that means they don't pay dividends. That's all that means. Very interesting. So let's look at financials. Okay, so we see, I don't know why my screen does this. It's like super annoying. Okay, revenue has definitely decreased since 2022. Yep, steadily decreasing. Okay. If I look at net income, it's been down. It went up a little bit. It went down some more. So net income is kind of volatile, but they're still profitable, right? So that's positive. Yeah, so let me see what Michael is saying. Hold on. Helen stock price has been declining due to a combination of factors, including disappointing earnings reports, management changes, and uncertainty surrounding tariffs. Yep, that'll do it. That all makes sense, Michael. That all makes a lot of sense. So with your comments saying that, the stock is technically at a discount when it was over $100 per share. So it all depends on how you see their future projections, right? So if you believe that the company will bounce back, then this is definitely at a discounted price. 100% agree. So I think in order to know that, you have to, and I'm sure you're doing this already, you sound pretty knowledgeable. You have to be listening to their earnings call, understand how they're navigating the space, but more importantly, how are they going to turn things around? And this is one of those things where I talk about being a more proactive investor. Now, you don't have to listen to every single company's earnings calls, but if you're trying to make a decision, things like that can help make or break your decision. And I always say you should have an investor checklist. I talk about this everywhere that talk about investing. And I think people don't really take it seriously, but it's so important to have one. Now, an investor checklist is basically 3 to 5 metrics you're looking at to determine whether or not you should invest in a company. And so it could be anything that you want it to be, right? What I want as an investor will be different than what you want, but you need to have some way to vet this company before you invest in them. And so I always compare it to applying for a job. So if you are looking for a job, no one's handing you a job, right? So a company's putting you through a process, right? They'll take your application, they'll look at your resume. If they like that, they'll call you in for a few round of interviews. If you successfully finish that, they then may do reference checks, background checks, maybe a credit check, and then they offer you the job. So you see how many steps you have to go through to get a job. And every company has their own process, but the key is they have a process. And so as an investor, you need to have something very similar. You need to have a way to vet these companies before you invest in them and also to monitor them along the way. And so if you have these, let's say 3 to 5 requirements, it makes investing really easy because now you have this like checklist either on a paper or in your mind. And when you're looking at this company, you're like, well, do they check all of the boxes that I have here? If they check your boxes, then the answer is yes. If they don't check your boxes, it could be a total no, or it could be a not right now. And so when you operate from that perspective, it makes investing one, a lot less complicated, and two, it makes it a lot easier for you. Now, what is on your checklist that comes over time, what's important to you versus what's not important to you, right? And then as you become more sophisticated, you might add more sophisticated metrics to your checklist. But the whole premise of what I'm saying is you need to have some way of vetting a company and doing research. You should never invest blindly in any company. I don't care how well they're doing right now. I don't care what their names are. You need to make sure this investment makes sense for you. So I do have an ebook. I'll put it in the caption down below. It's called Stock Market Investing for Beginners. I do break down investing in a way that's very simple and easy to understand in this ebook. And I also give you a way to start to put together your own investor checklist. So when I post this video, I will put that in the caption. But I don't see any other questions or comments, so I am going to wrap it up. But thank you, everyone, for tuning in. Thank you, Michael, so much for your feedback. I enjoyed our conversation today. Hopefully, you'll join me again next week. I will be here same time, same place. So I'm going to sharing, and I think that's it. So have a great weekend, guys. I'll talk to all of you next week. Take care.